Welcome back to Investing Talk Podcast.
Today, we're looking at UnitedHealth Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. UnitedHealth is, it's just a giant, it's really the bellwether for the entire U.S. healthcare system.
It really is. If you want to understand the trends, this is where you have to start.
Right. And you have to understand its architecture first. It's essentially two highly integrated segments. You've got UnitedHealthcare, which is the insurance benefit side, the payer.
And then you have Optum.
Exactly. Optum is the health services side. It's everything else, care delivery, tech, data analytics, you name it. And that integration, that's their real competitive advantage.
And it seems to be working. Looking at the recent performance, it's humming.
For sure. Q3 2025 consolidated revenues hit, $113.2 billion?
Yeah, that's a 12% increase year over year.
Right.
For a company of this scale, that kind of jump is massive.
And the growth was even stronger on the payer side. The UnitedHealthcare segment itself was up 16% in the third quarter. This isn't some new trend either.
No, not at all. The earnings momentum was there much earlier in the year. I remember back in April 2025, they raised their full-year adjusted EPS guidance pretty significantly.
They did. Moved it up from around the mid-$24 range all the way up towards $26.20.
Which was a huge sign of confidence, especially with all the headwinds everyone was talking about.
It was a substantial revision, and it all comes back to that structure we just mentioned, this combined payer-provider tech system. It's the moat. It's their competitive moat.
They can use data from one side to make the other side more efficient.
Precisely. In a way their more fragmented competitors just can't.
Yeah.
And that's really where Optum becomes the star of the show. It's the growth engine.
Absolutely. The engine for growth and for margins.
Let's look at the Optum Health numbers. In Q1 2025, revenue grew over 15% year over year.
Which is strong, but the margin story is even more important.
Right. That's the crucial part. Its operating margin expanded to 8.9%, up from 7.6% just a year prior.
That's the sound of the moat getting deeper. But what's really fascinating is the sheer scale of Optum. It's not just an internal tool, it's practically infrastructure for the whole industry.
That is the key distinction. Optum Health serves, 40 million patients directly?
Okay.
But then you have Optum Insight, the tech arm. That's the real defensive play. It provides these proprietary data platforms to 90% of the top 100 U.S. health plans.
Wait, so they're selling their technology to their own competitors, like the other big insurance companies?
They are. It sounds strange, but it's a brilliant trade-off. By serving their competitors, they make Optum's technology essential.
They create incredibly high switching costs.
Exactly. It's less about sharing secrets and more like owning the railroads. They get paid, they get more data, and they establish a scale that no single rival can touch.
And that flywheel is fueled by just immense amounts of capital. The free cash flow was $7.3 billion in Q1 2025.
And that's not just a number on a page. That cash flow is what they use to build out the moat. It lets them buy clinics, expand networks, and critically deploy next-gen tech.
Creating a capital barrier that smaller players just can't overcome. And they're putting it to work immediately. They invested, $2.2 billion in Q1 alone right back into Optum?
Right. And speaking of new tech, they announced that big partnership with Amazon Web Services back in April.
Ah, yes, for the generative AI.
Focused specifically on real-time prior authorization decisions. Think about it. That is a massive labor sink, a huge bottleneck in healthcare.
A huge burden, yeah. So automating that, it could dramatically improve margins down the line, but this all exists to solve a very big, very current problem.
It does. The Optum machine is great, but it's working overtime to solve the one thing haunting every insurer right now: soaring medical costs.
Okay, so let's pivot to that. If the top line is growing so fast, where's the pressure point? It has to be utilization.
It absolutely is. The main headwind is just people are using more healthcare services than anyone anticipated. Elective procedures, specialized care, it's all up.
And that really hit the bottom line in the first half of 2025.
Oh, significantly. Medical costs for the first 6 months shot up almost 16% year over year. That's a total of $152 billion.
So if you're trying to track this, what's the single most important number to watch on an earnings call?
It's the medical care ratio, the MCR. It's just your total medical costs divided by your premium revenue.
And any little change there has a huge impact on margins.
A substantial impact.
Yeah.
For Q2 2025, it was around 89.4%. Every little bit, it creeps up from there. eats directly into profit. So management's comments on MCR trends on the October 28th call will be critical.
Are costs stabilizing or are they still spiking? That's the question.
Exactly. And this pressure, it led to a really aggressive strategic pivot, almost a counterintuitive one.
They're actually shedding customers.
They are. They have a planned reduction of 1 million Medicare Advantage members for 2026.
Which sounds like a retreat, but it's really a calculated move to protect margins.
It's a strong pivot. They're prioritizing margin quality over pure volume. They're likely dropping members in unprofitable areas or under specific plans that just aren't working anymore.
So shed the most expensive members to stabilize margins at, what, 2% to 3% in that business? That seems designed to outperform peers who might just try to hold on to everyone.
It's a cleanup move. They're betting that this, combined with automation from Optum, will allow them to expand margins again in 2026, even with the utilization headwinds.
And that margin recovery story, it's clearly resonating with large investors.
For sure, institutional ownership is huge. It's at 87.86%. And you've seen big players like Norges Bank and Berkshire Hathaway increase their stakes recently.
But the insider conviction is what's really interesting here.
It's a very powerful signal.
In March 2025, the CEO, Andrew Woody, bought $12 million worth of stock.
And the CFO, John Rex, added another $5.4 million. I mean, when the people who know the books best are putting their own money in, that tells you something.
Definitely. So turning to the technicals, how is this conviction showing up on the chart?
Well, the stock has had a strong run, up 38% since the lows in August 2025. And it confirmed a pretty powerful technical signal earlier this year.
The golden cross.
Right. The 50-day moving average crossed above the 200-day back on February 3rd. For people less familiar with charting, it's basically a widely watched bullish sign. It suggests long-term money is committed.
And even after that 38% rebound, some analysts still see it as undervalued, trading around a 21x forward earnings multiple.
That valuation is entirely built on the idea that this margin recovery plan works, that the strategic cuts and AI efficiencies really do pay off in 2026.
So what does this all mean for the immediate future? What are the catalysts we should be watching?
The biggest one is that Q3 earnings release on October 28th. You need to watch two things: the MCR number itself and what management says about their 2026 guidance.
How confident do they sound?
Exactly. And right now, we're in the middle of the Medicare Advantage open enrollment period. So key data from CMS will start trickling out in December and then February. That'll be our first real look at how many members they're actually planning to shed.
And then looking longer term, there's always policy.
Always. There's a potential 5.2% rate increase for 2026 Medicare Advantage rates from CMS. As the largest player, that would be a huge tailwind for them.
A nice financial cushion to offset some of the revenue loss from those member cuts?
For sure. But, we can't talk about a company this size without mentioning the regulatory risk.
Right, the DOJ and FTC scrutiny over the whole Optum integration model.
Yeah.
Is it anti-competitive?
That's the top risk, absolutely. It's not just about legal costs. It's about potential restrictions on their core business model. But the market seems to view a lot of this as already priced in.
Because their defense is that this integration actually drives efficiency and lowers costs for consumers.
That's their argument. They're trying to prove that their model drives value and quality, not just consolidation, that their scale and their free cash flow allow them to invest in ways that make healthcare better.
So, to sort of wrap this all up, the core takeaway is that UnitedHealth's unique vertical integration, especially with Optum, gives it this incredibly strong foundation.
A foundation that's allowing them to make a tough strategic choice. They're taking a short-term hit on volume to navigate the utilization challenge and set themselves up for margin recovery in 2026. It's quality over quantity.
That's the story to watch. The real test isn't just top-line growth. It's whether these new efficiencies, the MA cuts, the AI implementation, can actually stabilize and expand those critical margins over the next couple of years.
And that really raises a key question for you, the listener, to think about. If this strategy works, if they prove that this level of deep vertical integration is the key to profitability, how long until their competitors are forced to try and copy it? And will regulators even let them? That's what will shape the future of U.S. healthcare.
Make sure you subscribe to the show so you don't miss our analysis on that margin story as it unfolds.